Okay, now we're moving to the state of the market in Philly. And as most of you know, it's been a really tough 24 months or so for life sciences in Philly. And we've got a great panel of people that are in the market every day and know everything there is to know about what's happening in Philly, and they're going to share it with you this afternoon. So our moderator is Nelson Way, the Director of Leasing and Development at the Navy Yard with Ensemble. We have Lauren Gilchrist, the Executive Vice President and Market Leader from Newmark. Anthony Meyer, President, University Place Associates. Tim Conray, Principal and Regional Director from Share Partners. And Joe Coletti, Executive Vice President from Jones Lang LaSalle. Welcome.
Thanks, Nancy. Good afternoon, everybody. I'm Nelson Way, Director of Leasing and Development with Ensemble Real Estate Investments. At the Navy Yard in Philadelphia, we're leading the transformation and expansion of the Navy Yard, which is currently home to over 1 million square feet of life sciences, R&D, and manufacturing space. This transformation will entail expanding upon that 1 million square feet to accommodate up to 4 million square feet of life sciences space, adding thousands of residential units, about 600 of which are under construction today, retail space, and multiple hotels, all in the spirit of fostering collaboration and growth. I'm honored to be moderating this panel today. I'll let each of the panelists go ahead and introduce themselves, and then we'll get right into it. You want to start, Lauren?
I'm happy to. Well, it's great to see all of you. I'm Lauren Gilchrist. I am the EVP and Market Leader for Newmark in Greater Philadelphia. If you're not familiar with Newmark, we are a third-party commercial real estate services firm. We specialize in office, industrial, retail, multifamily, life sciences, and we lease, sell, finance, construction manage, and also property manage all different asset classes. I have a bit of a life sciences background myself. I've been focused on the sector for at least 5 years right now, and I lead the team in Philadelphia, which is about 160 people across 5 different offices within the tri-state area.
Hey everyone, Joe Coletti. I'm with JLL. I've been here for 15 years now, focusing primarily on working with life sciences clients in the Philadelphia region. I'm also part of our National Life Sciences Advisory team, kind of connecting with other like-kind brokers across the country in top-tier life sciences markets to discuss best practices, what's going on in the other markets, and what can we bring back to the region. Working with everything from upstart biotech who need one bench in an incubator, all the way through big pharma, selling campuses, helping them with strategic initiatives.
Tim Conry with Share Partners. I opened up an office for Share Partners in June of 2020. Share Partners is headquartered in Rockville, Maryland, focused on scientific real estate. Approximately 60% of our revenue comes from scientific and life science real estate, but we are a full-service brokerage and construction management firm. We also have a development arm that we just spun out called South Duval that's been very active in this area as well.
Good afternoon, Anthony Meyer with University Place Associates, partners with Scott Mazo. We're headquartered in University City, focused in University City. We're building out a 1 million square foot life science campus. We just delivered a LEED and WELL Platinum life science building last year. And I'm excited to share a little bit of those insights as an owner, operator, developer.
Thanks, guys. So without further ado, let's jump right into it. What is the state of the Philadelphia Eagles? I mean, life sciences market.
The first question was way worse.
If you could touch on kind of where we are today, how we got here, that'd be helpful.
Well, I'm happy to start, and I'll try to keep it brief. So, the state of the market right now is very much influenced, as everybody I think in this room knows, by the financing environment, the seed capital environment that goes to support the startups and established companies within the region. And happy to say that even though the venture capital environment has been very subdued over the last 24 months, the NIH funding environment continues to be extremely robust, and Philadelphia continues to top its record-breaking level levels that have exceeded about $1.4 billion last year. So this is really good news for the basic scientific research that continues to happen within the university's campuses, within our incubator and startup ecosystem. And I think, that's good to report, and I'm happy to say that I think that the medium term for the sector, both the science and the companies as well as the real estate, is quite healthy. What has happened here over the last 24 months, though, is we have had a real estate market that has responded to an intense need for space for particularly, kind of call it graduate companies coming out of incubators to occupy their own space within, traditional real estate footprints. That market finally caught up to the demand that existed pre-pandemic, while the demand began to evaporate or slow down over the course of the last 24 months. So the market's been very slow in terms of the tenant demand and in terms of the lease signings. And at the same time, we have seen record-breaking levels of new construction in the University City area in particular, and throughout the city really as a whole, with some projects actually kind of going pencils down for the short term until some of the demand conditions improve. So this means that we have a good amount of space in the market overall when it comes to availabilities for tenants, and because there's a little bit more space, the tenants in the room are probably excited to know that that's improving their leverage a little bit with some of their landlords. Sorry, guys, but it's true. And landlords are excited and thirsty for those deals. So it's a good time to be a tenant, a little bit of a challenging time to be a landlord. And at the same time, while we have seen some of those projects go pencil down and the science continues to go, I would expect that the demand environment, unless something catastrophic happens, which I don't anticipate, to really kind of catch up and begin to keep up in the next 2 to 3 years. So all is not lost. And at the same time, comparatively, we are in a much better position than some of the gateway life sciences markets, the premier life sciences markets like Boston and San Francisco, which are seeing vacancy rates balloon up and over 25% in very high cost construction markets, in very high leasing markets. And so we will be in, I think, a better place to absorb the space that we have as it does come online, because in the traditional Philadelphia sense, we never see the high highs, we never see the low lows, but we do have a couple, of months here or maybe 2 years of supply that we do need to churn through. So it's a mixed bag with a positive medium-term outlook.
Thanks, Lauren. With that, how are tenants thinking about their space? We hear all this news about what's happening in the office world, right? We've got soaring vacancy rates and a little bit slow to come back to office. Life science is a different animal. Would love to hear a little bit of commentary from the group on kind of the mindset behind a lot of these space users, probably prior to the slowdown over the last couple of years, and where their mindset is currently and where you think they're going over the next 12 to 24 months.
Yeah, I'll take a stab at this. Just to kind of piggyback off Lauren, I'll paint a quick picture. Thinking about tenants and market as a data geek a little bit. In 2022, we had about 1.7 million square feet of tenants in the market, specifically for University City, not even the Navy Yard or some of the manufacturing uses there. At the end of 23, it was less than 750,000 square feet. Right now, I'm looking at a tenants and market list that looks like about 500,000 square feet in University City. So that puts us at as an owner-operator, a little bit of concern. Now, we have great institutional investment behind us, Cantor Fitzgerald, Global Investment Bank, Silverstein Properties, iconic developer out of New York City. So it gives us the ability to be a little bit more creative and even aggressive. So when you think about the tenants' mindsets that we're going after, of that 500,000 square feet, a couple of them are big users, 60, 70, 90,000 square feet. So we try to get very aggressive at this point in the market. Not these brokers, but other brokers would have the rally cry that would scare my institutional investors and say, survive till 25, Anthony, I'll talk to you later. Well, we're going to be in 25, and I really do believe we're going to thrive in 26, but mainly because we've chose our investment partners, and I know you have a great one too, Nelson, but we chose our investment partners carefully. So the mindset of these tenants that we're going after, they don't want to spend their hard-earned, conserved cash, so we're spending more TIs than ever before. Our tenant improvement allowance budget that we had with our institutional real estate lender was about somewhere like $130 a square foot budgeted. We're crossing $200 a square foot right now and how we can be aggressive because we're going after the right. Now, the signs thing did not get any worse in Philadelphia. In fact, it got even better. So it allows us to be aggressive with not only how we deploy our capital, but hopefully go after the best signs out there.
Yeah, I would echo that, Anthony. It feels like flexibility is key right now. As you mentioned, we had a certain amount of TI underwritten when we started developing lab buildings. We built a spec building at the Navy Yard. We're certainly crossing the threshold that we had drawn for ourselves, but it's great to have equity partners that understand where we are in the market, that are able to be flexible, to adapt to changing needs of tenants, to look at deals different ways where we're essentially the bank providing all of the tenant improvements, or if the tenant wants to do it themselves, we're happy to take a lower rental rate to reflect that. I think flexibility is enormous in today's market. Subleases have always played a role in kind of the leasing environment. What are we seeing today? What have we seen over the last, call it, year or so in terms of subleases? Is that eroding any of the kind of the market that we're looking at?
I'll take a stab at that. So I think you have to look at a couple of things, right? Pre-pandemic, I think the story in Philadelphia, specifically University City, was, if you build it, they will come. We don't have the product to land some of these tenants. People can't wait around for it. So then we had the highs of kind of COVID and post-COVID. Developers like Anthony and Ensemble, Brandywine and others kicked off buildings with the hope and goal that there'd be the tenant demand to keep up with the financing world, with the new startups that were coming out. Coming out of the incubators, which I think, if you look at the ecosystem, the incubators are all still pretty full. Those companies, we all know they're not all going to make it, but majority of them are going to grow. They're going to turn into other companies. They're going to go somewhere else. So I think right now where I see Philadelphia positioned is we have, call it 1.5 million to 2 million square feet in University City of kind of lab-ready space that will be ready to attract demand once the market picks back up. In the interim, we have great incubators. We have great graduate spaces for people to grow, kind of piecemeal versus, hey, we raised Series A, we're going to go grab 60 to 90,000 square feet. I think those folks today are probably looking at a floor or two versus maybe 3. And we're seeing that in the market where there were some companies who went out and maybe took a little bit more space than they needed, or they thought they were going to have the growth, and obviously no one could foresee what happened with the market. So we are seeing pockets of sublease. We saw Wistar, sign a deal at 3675 in the Amicus space, but there is other pockets of existing sublease space that's sitting out there and no one's jumping to take it, which is also an indication that the market is slow, right? Because if you can grab sublease space versus building out your own space, you're saving tens of millions of dollars, and there's brand new space sitting there right now, waiting for someone to jump. That said, I do think when the market starts to turn, and we've already seen some tenants come out, we've seen a couple deals sign, those are going to be the first deals to go, and then you're going to look at, all right, let's build brand new space at Ensemble's building, at 3.0's building, at the other building. So I think we're well positioned. It just takes a little bit of patience.
Rebecca Grant spoke about the strength of the Philly ecosystem and the market here. How, in your perspectives, does Philly compete against a Boston or a New York City or a Washington, D.C. or North Carolina, taking into account the ecosystem, but also kind of the sublease space that you just mentioned?
I'll take a stab at that. In terms of it's funny, in Philadelphia, you talk about the ecosystem, and they kind of leave out New Jersey. I think the strength of the Philadelphia market has always been in the academic settings. You have a lot of research going on, and those tenants, those researchers, they have a good product. Next step out is to get into an incubator. And I think Lauren pointed that out, and as Joe pointed out, the incubator space is kind of full. So unlike a law firm that has a lease coming up that has to do something, I think there's a hidden demand in that smaller use market that's sitting in the academic setting that isn't realized. It's hard though to start a building and lease up space when someone's coming in, they just want a bench or two, and that's why companies like CIC and biolabs are so important. However, I think that we're working on a project right now. We're building a building for Coriell Institute in Camden. It's be a 90,000 square foot research building with a vivarium and a lot of biobanking. The cost of that project is $85 million. The lending on it kind of got stuck at around $40 million. So you hear about this all the time. You hear the interest rates are going up, which does make things cost more. It does make the rents go up as well. But on top of that is trying to find, to fit into that box to get that money is very difficult. Very few banks are even lending right now, and hopefully it'll loosen up a little bit. The other piece of that is the equity piece. If you are out looking for space, the first thing you would do is, just like Anthony said, make sure the buildings you're looking at and the owners have the money and the debt to actually fund tenant improvements. There's a lot of lenders that won't fund tenant improvements right now. So you can kind of get down the road on a deal and just to find out that there's no money available to actually build out your space. So that's important. I think the government is going to have to play a bigger role in New Jersey for the Coriell project. We're getting about a $40 to $50 million bond from the state, from the county, and the state of New Jersey is putting in a $20 million investment from one of their innovation funds. So we'll match that with another $20 million of equity from Coriell and complete that project. But it took a year and a half to get that. We have another project that we're doing similar down in Delaware. We're going to build a 140,000 square foot building. We weren't going to build it spec, but we actually, on the build it and they will come, when we finally announced it, we actually landed a 65,000 square foot potential tenant. They signed a term sheet. You go back into the financing, and that's where it gets bogged down. We finally got some banks to lend, but when it comes down to the equity piece of the equation, the question is why do I want to risk money and put it into a building in Newark, that's going to cost maybe $600 a square foot, where I can buy a building in Philadelphia that has cash flow like the Bourse for $100 a square foot. So that's kind of making the equity side a little bit harder to put together. So I think that New Jersey's being really aggressive with money right now, and Rowan University is going to do a similar project. And the idea is use the university to not only ground a development, but also to be able to create additional space for an incubator to bring in investment and bring in outside companies. And I think you're seeing that happen in a lot of the universities. We're doing something like that in Bozeman. We're doing it at the University of Washington in St. Louis and a couple others as well. So
I want to piggyback on that real quick. Yeah. I'd bet on Philadelphia every day, twice a day. Think about in 2017, how many incubators were in Philadelphia? Not a lot. We just had a whole stage full of incubators and accelerators that are launching here. The next product is spec suites. There was no spec suites 3-4 years ago. So now graduate companies have a place to call home. There was no Varium service providers. We have Cradle, there's a MISPro. They're in our ecosystem. This ecosystem is about to thrive in the next venture capital unlock moment. The science is only getting better. You have big name scientists like Jim Wilson spinning out of University of Penn to go private. You have more new dollars coming into Philadelphia than ever before. And I can't wait to see what happens in 2025, 2026, because I think all the ecosystem stuff that's been built and invested in, the ROI is yet to come. Gardner, the CBRE guy that was up here a little bit ago, I used to use the CBRE fact in all my deck presentations to future investors. It was the amount of multiple associated with incubator space. There's a formula, I think CBRE and some others have kind of refined, that can predict the growth. So do we have too much product here? I don't think so. University Place, 3.0 University Place is 250,000 square feet, a lab office. I'm talking to 2 users now that can fill up half that building. So when things do get back on track with venture capital, these buildings are going to fill. The ecosystem is going to be stronger than ever because of what's here. And I can't wait to see what the next evolution of growth looks like.
One more point on that. I know we're a little short on time, but what we saw in Philadelphia in contrast to Boston and San Francisco. So Boston and San Francisco, because they are gateway life sciences markets, you got a lot of people piling on that didn't have a lot of life sciences development expertise, and you got a lot of dispersion in the ecosystem, which means that there's projects that got off the dock and got financed in Boston and outside of San Francisco that never should have been off the dock and financed, with developers that didn't have any track record in doing so. And as a result, there's a lot of suffering on the landlord side in those markets because there's too much supply and not enough expertise. And we didn't get that in Philadelphia. I mean, we do have a robust suburban market driven by our pharmaceutical companies, but we didn't get inexperienced, undercapitalized groups in far-flung, questionable deals. And that will continue to enable our market to be successful because we've built it intentionally. The companies in this room have built it around the institutions and around long-term talent at the pharmaceutical companies, and all of these ingredients in the ecosystem make it sustainable for challenging times like this one.
It's fantastic. Well done. Real quick before we open it up for a few questions, predictions for the next 12 months, 24 months. We've got interest rates that are coming down. What are we thinking? I'll go first.
Great.
I think Anthony started going down this path, and we talked about it a couple months ago. I think that there's inventory in the market, right? We talked about how that inventory is going to fill up probably over the next couple years. And then what, right? Then how do we react as developers? And I think the answer across, for Ensemble, for my firm, for our partners, for Anthony and his partners, for Brandywine, for Wexford, we're all saying, okay, we've got some space sitting on the market. It's going to lease in the next year to 2 years. What's the next building we're building? Like, there is so much faith in the science that's happening in this city, in the ecosystem that's continuing to be developed, and I think what is happening at the state level in terms of incentives and funding to propel this growth within Pennsylvania and keep it here. I think this growth is going to continue to snowball, and I think it's going to happen, probably a couple years out. We'll be talking about some new developments.
I think that on the scientific side, we're overdue for a blockbuster moment. I think of Spark as being one of our big blockbuster moments a couple years ago with their acquisition by Roche for over $4.8 billion, I think it was. So I think we're overdue. I think, especially hearing some of the news and information of, Jim Wilson going private and some other organizations, that have really incredible science. It's only a matter of time before one of them pops. And we're going to be here with the space, with the talent pool, with the ecosystem to be able to maintain that in Philadelphia. And I think it's great news that we've got, Mayor Parker as well as Governor Shapiro very focused on this sector. And I hear in every single conversation about the economy, one of them talking about life sciences, which I think is great for all of us.
Great. Nancy, do we have time for a few questions here? Great. I will say it's humbling being up on stage at this event talking about real estate after all the amazing, brilliant science that was being discussed earlier today.
They couldn't do it without you.
We're just a piece. Great.
Infrastructure.
Yeah. Well, thank you.
Thank you.